Welcome everyone to NAAIM Confidential Live.
Hi, everybody. Welcome to NAAIM Confidential Live. My name is Kenton Kilmer, and today we are joined by Dr. Michael Geke, founder of Quantmade, a 220 million euro quantitative asset management firm based in Dusseldorf, Germany. Quantmade is known for its AI-driven, volatility-focused approach using machine learning across mega and large cap US stocks. Their strategy is long only, non-levered, and deeply contrarian, based on forward-looking volatility probabilities rather than price direction. Under Mike's leadership, Quantmade recently won Germany's prestigious Future Fund Star Award for Best Investment Strategy. We're excited to dive into the details. Kick it off, Mike. Tell us a little bit more about Quantmade.
Well, Ken, honestly, this was one of the best introductions I've ever had. Thank you very much. Thank you very much. And happy to be today on your show, in your podcast. It's at the moment 10:30 p.m. here in Germany, so the sun is already going down. Let me introduce myself. My name is Michael Geke. I'm the CEO of Quantmade. I founded this company in 2018. We are specialized in the development of computer-based and AI-driven quantitative investment models. We are positioned as a quant as a service company. This is our main positioning. Let me share with you some small slides so I give you a flavor of what we are doing. So actually should pop up here. What we are doing is we built in 2015, where we started, we built what we call the Wealth Tech Suite. We have then we started with managed accounts for family office, high net worth individuals. And in early days, then we in 2024 we began developing so-called actively managed certificates, and in 2025, just 1 month ago, we launched the first UCITS fund. What we are doing to bring all things together. We have about 250 managed accounts running with an average volume of 900,000 euros. We operate 51 quant models and 14 quant portfolios operationally in the market. These are different models, all kind of models, but we mainly focus on short-term volatility, identification pattern and forecasting models to predict future price action. We run this 220 million asset under management. We are mainly active in Switzerland, the Netherlands, and in Germany, mostly in the European Union. And we have an intention to come to the US and serve our clients there also in the next couple of months.
Yep, we're looking forward to being a conduit to your success here in the United States. So congratulations.
Looking forward to meet you there.
And of course, thanks for staying up a little bit later than you might normally on.
Yeah, I'm very sorry that I look a little bit tired, but we had an opening party yesterday from one of our offices, so it was a good party, honestly, and I think so. I still suffer from it.
All right. Well, we'll forgive you for that. So I was looking at over the notes that we were discussing, and you had this really interesting way of using volatility forecasting within a very specific 10-day period that you've found has the most precision within your modeling. The first thing I wanted to ask is, I know that you defined volatility internally, and that is somewhat meaningfully different than what other people might define volatility as, especially folks that might be connecting it to the VIX or other ways that it's retail digested volatility type of indicators. So what do you track? And why is that 10-day holding period or forecasting period meaningful to you?
Yeah, okay. I think the volatility is a broad term, and when we talk about volatility, we should define precisely what we are talking about. There is a group of people talking about volatility, and they mean then the wicks and these kind of things. Then there's a group of people talking about volatility indicators used in their models, etc. When we talk about volatility, we just mean the swing volatility of an underlying, let's say, a stock, an index, or these kind of things. So for us, important is that that what we are trading has a certain volatility, a swing pattern that we can identify, and from the swing pattern analysis, we can forecast future price action. Our what is our belief in this? Our belief in terms of using quant models and working professionally to build a sustainable risk-adjusted performance for our clients is that if you use really quant models, then we want to really get an edge from our analysis. And getting an edge from your analysis vanishes over time because your prediction vanishes over time and you approach 50-50. So our real edge, investment edge, has a very good chance to evolve over a period of 10 to 20 days. Now, this is why we are not a long only, we are not a fans on it, honestly, on long only. We are also not a fan of building strategies that achieve a 50% return on a stock. We are more a fan of, instead of one time 50%, we do 10 times 5%. And this we can produce this 10 times 5% much better, and take the instead of the 50%.
And so, I wonder, why don't we look at one of your individual trades? I think in the pre-call, we were talking about Coca-Cola.
Yeah.
A chart of Coca-Cola, and it would be interesting to use that as a way to take a look, your typical swing trade setup and how your model helps you decide entering or exiting a name.
Now, let's put it this way. I pull up the Coca-Cola chart in a minute, but if you really want to build a strategy that delivers sustainable, profitable performance with low volatility in your equity curve and reduce drawdown, avoid volatility in your performance curve, achieve something in the range of a Sharpe ratio of 1.5 up to 2, then it is not possible to stay in a position for a long time. You need to take shorter turns. You are forced to trade on shorter time. You are forced to improve on your timing, and you have to have more concentrated portfolios. Otherwise, you will not be able to improve on your Sharpe ratio. So this is the only belief that we have. So what we are doing is we are vectorizing all the historical chart information and have a stochastical model to predict future price action. And based on what we do is every day we calculate the upside and the downside probabilities of every US stock. So we mainly focus on we focus mainly on the mega large caps because they are the best liquidity. It's interesting, by the way, to employ these models that we have also to small caps in the US. And honestly, the less the liquidity, there are certainly differences in terms of performance and volatility of the performance curve.
Yeah,
so we don't like the small caps, honestly.
Right. You were saying small caps typically correlate to weaker performance because of a variety of volume being one of them.
Yeah, well, you can really plot a linear regression on this in terms of performance and liquidity in the market.
Well, let's take a look at Coca-Cola. Let's take a look at Coca-Cola.
Yeah, and if you apply these models, then, for example, this is a Coca-Cola chart. It's just as an example, and I can send you a book of all these examples because all these patterns evolve on the same way. Our technology is centered around identifying these turnaround swing reversals. And the important thing is that you identify, if you want to trade professionally, you have to identify the turnaround when the turnaround happens and not when a turnaround is through. The most models that you use on short-term swing trading identify a turnaround once the turnaround is already gone. So these in situ models, we call this in situ models with a zero leg, are able to detect based on stochastical analysis the turnaround when it happens. We don't trade in these noisy areas. This is not important for us. So we need an edge in the chart. The edge in the chart comes when we have a direction that goes down. Like here for the first trade, then we are the trade for a short period. We get some $2 or $3, but we are happy with this. Here, then we had a trade here. It goes in. We are out here. The length of the period depends on the probability that decreases over time. So that's part of our model. So we enter a position with 80% probability, but we exit a position when the probability is 50-50 versus upside and downside. But you see here the period, the time period, as well as um, the amount of profit that we got from this trade was completely different, but the 50-50 point was reached already here. So this is why we exited the market. Here is also the 50-50 point. Then this was 2022. Here is the year change. This is 2021. This is 2022. We get a lot of volatility in this in Coca-Cola. So we got some very nice swing patterns that we can analyze. And we bought here, we sold here, we bought here, we sold here. In total, it was around $16 versus staying in this position, you end up at $8. So this is what we don't want to do. And if we have if we close a position, then we are again in cash, and
So,
again yeah.
so I'm just asking, something that stands out about this is
Yeah.
it really looks like the entries are at the bottoms, at the troughs of
This
the
is the objective. This is the objective, yes.
and that's the objective. It makes sense. So but it seems to be quite effective within this chart. Looking at this chart, we have an example of being able to enter at a trough between September and October, and then we had another trough just around December of that same year. What was different about the late September trough and the December trough that didn't trigger in December?
A very good question. Very good question. Ken, the situation was what you see here is limit, 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 limit. We always enter a position with a limit orders. So the optimal entry point for a given day. So we have a signal day and we have an entry day. The entry day is the day after the signal day. So we once we have a signal day that we want to enter, then the next day we place a limit order, and this limit order is valid for the whole trading day. We place all these orders before market open. So there was a trading. Honestly, I believe me, there was a signal to really enter the position. But what you see here, the signal was quite good, and the chart didn't touch our limit. So unfortunately, it already went away.
Okay.
And we just missed this trade. The limit was not hit.
I understand. So it wasn't about
Unfortunately.
a signal indication. It was more about risk management and the limit orders for the trades that you placed.
Pardon, the limit orders?
Yeah, it was a risk management of making sure that you got the right price that you were going for.
Exactly.
It didn't
Yeah,
hit.
but it's also a part of we don't want to enter a position in if if you do this short-term trading and not this long-term trading, when you stay in a position for a longer period of time, let's say you follow the trend, do some trend following strategies, then the entry over day is not really crucial to success. But if you have shorter time periods and you do swing trading on a shorter time frame, like a couple of days to perhaps 2 weeks, then the entering a position is crucial for success.
Okay. Yeah, that's really well said, and highlights not just the signal creation and the volatility modeling, but the discipline and portfolio management. Uh,
Exactly. And
I
by the way, we exit also the position by with a limit. Yeah? We have we don't put their market something like this. Yeah.
so let's take a look at your chart about what's happening over the last how many months? 12 months, and what's going on into the future.
You mean this chart one?
Yeah, this is because I know this one's up to current, or no, it's up to just earlier this year.
It's just earlier this year, exactly, and I prepared a slide to illustrate on a longer time frame of what if you follow this kind of methodology for short-term swing trading, where you generate the trading signals zero leg with an in situ mechanism, so the signal is generated at the moment when the turnaround happens, then you forecast over a period of 10 days. If you have a probability of 80% and you enter the position. By the way, if we are not right, we are exiting positions at already 5% from the entry level. So we have an exit, 5% entry exit, or let's say a stop level where that triggers our exit immediately for the next day. So if we are not right, we have a good chance. We are exiting positions at the right. Yeah, let's after a short with this 5% threshold. But what you see here is quite interesting. This strategy that we are using, we have three different types of strategies, and the one that enters position with 80% probability. There are two other ones that enter positions with 75% and 70%. So now we are looking at managed accounts, managed with a very, we call this a defensive or conservative version, entering positions only with 80% probability. And if you do so, then you end up over the last 4 years, you ended up with a nice Sharpe ratio around 2. You ended up with a max drawdown over the last 4 years, so 2021 to 2025, with 3.9% drawdown. And this was really exceptional for a long only strategy, unleveraged, without we don't use any future overlay or anything like this in this kind of strategy. Honestly, we do use also these techniques, but in other strategies. And what you see here below is our investment degree. The investment degree is if we are 100%, then we are fully invested. Fully invested means we have 40 positions in our portfolio, and zero is we have 100% cash. We allow this strategy to fluctuate between 0 and 100% cash. So cash is really part of the strategy. Cash
And,
is a critical element in the strategy. So,
and
and to avoid drawdowns, we stay the strategy stays for periods. It stays also in cash because this way we can avoid drawdowns with a long only strategy.
so and then you mentioned that right now you're heavily weighted in cash. Why is that?
Mm, at the moment, the question why is a very good question. Put it this way, we currently we are 90% cash because we don't find with our defensive versions of our strategies suitable entries with an 80% upside probability over the next 10 days. So this is very simple to answer. If the algorithms don't find, and especially our clients that want, we have a lot of clients that want to have a very stable very high Sharpe ratio, but still profitable performance of their personal equity curve. So they want to avoid drawdowns. These people are 55, 60, 65. They don't want to make experiments with 20% or 30% drawdowns in their equity portfolio. They want to have something that develops stable. So this strategy that we employ here helps them to have a much better market timing and enter positions once there is really a high probability to get where we can get an edge. But if we have no edge, then we stay in cash.
Well, it's very clear from this line chart that you have up right now that that smoothness in being able to avoid drawdowns and your use of cash as a constituent in the portfolio does lead to this target desired outcome as you've described here, Mike. I want to take a step back because, this is an opportunity for us to kind of share mindset and share knowledge base amongst groups here in the community. And, you've built a strategy with strong real world discipline and clearly live performance. What would you say is most misunderstood about AI driven investing, especially compared to other active managers you speak to?
What is most I think I think there's a lot of fantasy behind using AI technology to improve on your trading results and implement AI-driven strategies to really do something great. But for me, AI and our company, AI is just an enabler. We are what we do is we focus solely on really data that have a high data quality and high data quality, also high historical data quality. It can only be derived from historical chart patterns. Let's say we use AI also for a lot of other information that we put into our model, let's say alternative data. And the alternative data suite is at the moment not very much extended. We don't have periods of 10 years of alternative, 20 years of alternative data that have a consistency in the way they are produced. So this can lead to a significant wrong data models when using AI, just using, for example, alternative data. This is why pardon?
I was going to ask, so do you think that maybe your perspective on AI is in part biased by the short-term nature and really being able to profit off of that 80% to 50% probability on that very kind of relatively short-term high conviction, where in which perhaps there's new models that might help with more qualitative data or longer horizon data or longer horizon that perhaps just doesn't really touch your strategy as directly?
Yeah, that's right. What we are doing is, but the AI that we are using, honestly, is for us an enabler to calculate the probability pattern. Yeah? This is where we need the AI for. This is a crucial success factor to calculate our probability patterns. Otherwise, we wouldn't be able to do so. But and what we use is the methods of, for example, reinforced learning. These activities. These are machine learning stuff. The other technologies that are at the moment around to use AI for completely different aspects of identifying the edge. That's something we are not employing at the moment.
Right, right. And it sounds like, and any forecasts for trying to expand that suite given the new technologies available?
Yeah, sure. We at the moment experiment to increase our holding period.
Mhm.
It's like a little bit that uh, if we stick at the moment, we are able to predict a window of 10 days. This is something where we feel very comfortable with. And if you want to predict over 10 days, 80% probability under your distribution, the what you call the cumulative density function, you will not find too many trades because only a part of the whole time you are invested, because you don't find the setups. So the idea is at the moment that we, like in the weather forecast, you want to predict in weather forecast, is it also going to be sunny in 14 days? Is it sunny in 20 days? So you are able to predict in weather forecast, oh, it's going to get sunny in the next 5 days, or you believe in this. Yeah, if you watch the weather forecast, you see this. But over a 20-day period, you won't believe, oh, is it really going to get sunny? No, we don't know. But
Oh
the
yeah,
same
three
thing
or
is
4 days.
also, yeah, but the thing is, but this is actually the field where you need to, what you need to dive into, because then you can, if you can cover different time frames and periods where you can be active, you can have layered strategies, layered quant strategies where you really can improve also on your Sharpe ratio, and applying them in parallel will help you at the end of the day to level out volatility in your performance pattern. So this is part one, what we are working on at the moment. Second thing is that we employ quant driven option strategies. So we use our option, the same quant models, also not to trade everything what we are doing with equity, but we have now developed combinations of quant triggered option strategies. What means that shall we go more with a short put, or shall we in terms of just equity position, or these different models that help us to give also an edge into what we are doing.
Well, it seems like what you're doing is working, Mike. So, if you found new technologies that help you and you've seen deliver a better Sharpe ratio, great. But
That's
certainly,
the only thing what we are working on, honestly. This is the crucial thing what we are working on, Ken, is to avoid the drawdown, to avoid volatility. This is the mission of Quantmade. We want to deliver something that we don't go out and say we are the 80, we don't deliver to you 80% or annually or these kind of things with a volatility of 50%. This is not what the clients are looking for. Our clients are seeking a suitable performance of, let's say, 10 to 15% annually, with an annualized volatility between 5 to 7%. And if we can deliver this, then we are absolutely fine.
yeah, I'd say so. Well, Mike, we are at the end of our time here. Thank you so much for
Oh,
coming in, staying up so late, giving us your pearls of wisdom, and we
now I
look.
get now I get awake.
Well, if you'd like, we'd like to hear as a closing statement any additional pearls of wisdom you can grant us in conclusion.
Ken, that is great. Thank you very much. Yeah, yeah, you asked me for this, and one motto actually, what we are working on is the best drawdown is the drawdown you don't have. So, and the best long-term strategy is built with short-term trades.
From your lips to God's ears. Have a great rest of your weekend. Thank you so much.
Ken, all to everyone.